Good morning and happy Monday, guys. Let's get to work here. Take a look at the market and futures down about 1.5%. Take a look here at the futures for the Qs, down 1.5% as well. So the selling pressure continues, guys. Here's something I'm taking a look at. All right, for what it's worth, during the course of a healthy uptrend, we respect the 21 EMA here on the weekly chart just like we do on the daily chart. So in the event the market drops below the weekly 21 EMA and the moving average itself begins to turn to the downside, you get some ugliness ahead. So the way I'm looking at the market right now, guys, is we could actually fade a good amount more, and this overall trend, the bull trend here, is still going to be intact. So I am kind of looking at that weekly 21 on both of the indexes as just a reference, potential level of support, not kind of a make or break it. But I do think it's interesting, guys, that we are potentially heading towards that level. And then obviously you just kind of look at the history of a weekly chart here. Not much good comes from us dropping below the weekly 21. So we will see how things go. But really, guys, what I want to focus on this morning is just the environment. When the market is choppy like this and, potentially weak, you got to play what the market's giving you. And I'm a huge advocate right now of being a seller of an option and not a buyer of an option. Last week, guys, we made some really good money shorting a couple of stocks in the market, but we did so with call credit spreads, getting away from the noise. So a lot of us in the group, we locked up some nice profits last week on a Netflix call credit spread where we sold calls up here at 520, away from all the price action. Everybody else is getting torn apart in the chop. You want to sell somebody an option far away from the chop and then collect the premium. So Netflix was a great trade. A couple of times last week, guys, a couple $1,000, selling calls here on SPX, call credit spreads, away from all the crap. On Monday, got a call credit spread up here at 34.50 and was able to close that on Friday for just about max profit. And this morning, guys, and this is why this is important, I'm coming into this morning's session long 3 different stocks, Tesla, Amazon, and Spotify. Now, typically, when you hold 3 long positions over the weekend and you wake up and see the market is gapping down almost 2%, that's usually not a good situation, right? But the thing is, guys, when you're the seller of an option, you actually don't really stress when the market gaps down like this. What I mean is, yeah, I'm long Tesla right now, but I'm long in the form of put credit spreads. I didn't buy calls. I didn't buy the stock. I sold somebody else a put. Now, granted, of course, Tesla's doing Tesla things and holding up just fine this morning. Got a beautiful 4-hour, 2-hour, and 1-hour squeeze you guys should check out. But nonetheless, I got put credit spreads at 415, 405, and 380. I'm not concerned about the market dropping here because I got cushion. I'm also long Amazon. Now you guys can see, right? Tech is down almost 1.5% here. I'm long Amazon, but I'm long Amazon in the form of a call credit, in the form of a put credit spread down here at 2,700 that expires in October. So I'm able to see the market gapping down, knowing that I'm in good shape on Amazon. Unless this thing's going to gap down 250 points today, I really don't need to concern myself with the noise. And I'm also long Spotify. Same thing, October expiration, put credit spreads, and I'm down there at 220, away from the noise. So, rule of thumb, team, once we drop below that 21 EMA there on the daily chart, bare minimum things are going to get very choppy, if not very weak. Regardless, though, the chop is what can kill you. You can make some money buying puts when we're trending to the downside. That's not too hard. But when we're chopping, that's when being the buyer of a call or being the buyer of a put, by design, mind you, can be very difficult. Because they run the market up and then they sell you the calls, just like I did there on SPX. They run the market down and then they sell you the puts. And all they want to do, guys, is sell you the dream and let all that premium go into their pocket as you're eating shit on the position. So in this kind of market environment, guys, I am an advocate of being the seller of an option and not so much the buyer of an option. And truthfully, playing the market in either direction. So for me, with the spreads, guys, another thing I like is that we want to treat our trading like a business. And at the end of this week, I'll post up the Thinkorswim, balances, position sizes. I'll show you guys all the good stuff. But as far as my spreadsheet here, this is kind of my book of business, I call it. And with my spreads, guys, I kind of look at them as almost like accounts receivable. So between the 5 different spreads I have open here, and they expire, some this week, some next week, some in October. But nonetheless, guys, between all my open spreads right now, I got max potential profit of a little bit over $14,000. So that means, at least personally, I'm not so much heading into today's session looking to get aggressive, looking to add a bunch of positions, more so be patient, but at the same time protecting those open positions and potentially locking up gains on something like a Tesla as they come. So I wish you guys the best of luck this week. The market's going to continue to be choppy here. Keep an eye on that 21 EMA on the weekly chart for the indexes. And if you guys aren't too familiar with an option selling strategy like a credit spread, check out the videos here on the channel, and then check us out at focustrades.com. I'll talk to you guys soon.